Just imagine, you've built an absolute empire, a global giant, but deep down, you're hiding a secret so enormous that every single day feels just like this, like you're riding a tiger, and you just know, the second you try to step off, it's going to turn around and eat you alive. That's the terrifying confession from the man at the very center of this story. And that brings us to the story of Satyam Computer Services, a company that looked like a shining star, but was secretly pulling off a mind-boggling deception, fabricating more than $1 billion out of thin air and fooling the entire world. This is the story of how the man riding that tiger finally, catastrophically, lost his grip. But before we get to the implosion, you really have to understand just how high this company flew. We're not talking about some flash in the pan. In the mid-2000s, Satyam was considered one of India's absolute crown jewels.
So let's paint the picture. It's 2008. The Indian IT sector is booming, and it's the poster child for the country's economic success. And right at the heart of it all was Satyam, a name that, funnily enough, means truth in Sanskrit. It was way more than a company. It was a symbol of India's arrival on the global stage.
And believe me, it was a powerhouse. I mean, just look at these numbers. This wasn't some small operation. We're talking about the fourth largest IT firm in the entire country. 53,000 people on the payroll, working across 66 countries. Their client list? Oh, just a casual 185 of the Fortune 500 companies. On the surface, Satyam was an absolute juggernaut. And this is where the story gets almost unbelievable. In 2008, the very same year this whole thing was about to blow up, Satyam actually won an award, the Golden Peacock Award, for its corporate governance. They were literally being celebrated as a model for how to run a transparent, ethical business, all while hiding a billion-dollar lie. The irony is just staggering. You know, every spectacular collapse like this, it always starts with a single crack in the wall. For Satyam, that crack wasn't a bad earnings report or some failed product. No, it was a truly bizarre and desperate business move that made absolutely zero sense to anyone watching. So put yourself in their shoes. You're the chairman of this incredibly successful company. Everybody loves you, your stock is flying high. What's your next big play? Well, what Satyam's chairman did next was so completely out of left field, it set off alarm bells on every trading floor in the world. Yep, you heard that right. Satyam announced it was planning to spend $1.6 billion to buy 2 real estate companies. And the kicker? The companies were called Metas. That's just Satyam spelled backwards. And they were owned by the founder's own sons. I mean, the conflict of interest couldn't have been more obvious. It was so brazen, investors immediately knew something was very, very wrong. The market didn't just dislike the deal, they absolutely revolted. The backlash was so immediate and so furious that the company was forced to cancel the whole thing in less than 12 hours. But it was too late. The damage was done. You can see the stock just went into a complete free fall. Calling off the deal didn't stop the bleeding. Actually, it made things worse, because now everyone was asking a much scarier question. This wasn't just a bad business idea, it reeked of desperation. Why on earth would a company this successful try to pull a stunt like this? What was going on behind the scenes that was so bad they needed to do something this reckless?
Well, the world did not have to wait long for an answer. With his back against the wall, his desperate plan completely shot, the chairman, Ramalinga Raju, decided it was finally time to try and get off the tiger. Just a few weeks after that disastrous deal fell apart, a 5-page letter landed on the board's desk. And it was a bomb. Not an exposé from a journalist or a whistleblower report, but a full confession from the man who had built the company from the ground up, laying bare a fraud of almost unimaginable size.
First up, the headline number. Raju admitted that the massive war chest of cash the company claimed it had, well, it just wasn't there. Over $1 billion of it. It hadn't been stolen, it had simply never existed in the first place.
And to really put that in perspective, this wasn't just rounding up a few numbers. A jaw-dropping 97% of the cash on their balance sheet was pure fiction. For all practical purposes, the company was hollow. So how'd they hide it? Right here. They were reporting these amazing, healthy operating margins of 24%, making it look like a wildly profitable machine. The truth? Their real margin was a razor-thin 3%. They were barely making any money at all. So how does a lie get this big? In the letter, Raju explained it himself.
He said it didn't start out as this billion-dollar fraud. It started with just a small lie, a marginal gap, he called it, to cover up one bad quarter. But then that lie got bigger and bigger, year after year, until it grew into this uncontrollable monster. That whole Mitas deal, that was his last-ditch, desperate attempt to plug the massive hole of fake assets with real ones. Okay, so fessing up to a billion-dollar lie is one thing, but how in the world do you actually pull it off for almost a decade? Right under the noses of auditors, investors, and Wall Street. Let's take a look at the actual mechanics of this fraud. What investigators eventually uncovered was a stunningly complex machine. First, you just invent revenue. They created thousands of fake invoices to make it look like they were doing way more business than they were. Second, they created 13,000 ghost employees, people who didn't exist, and then paid out their salaries, which went straight to the executives. Third, they used this insane web of over 350 shell companies to move the money around. And what did they do with it all? They bought land, thousands of acres of it. And the scale of this is just, it's hard to get your head around. This wasn't a few fudged spreadsheets. It was an industrial-scale deception. Investigators found over 7,500 fake invoices that were created just to invent revenue out of thin air. Once that confession was out in the open, the fallout was swift, and it was brutal. The company, its world-famous auditors, and its celebrated founder all came crashing down hard. Now, this comparison is just devastating. You have PricewaterhouseCoopers, PwC, one of the biggest, most respected accounting firms on the planet, signing off on Satyam's books for 9 straight years and seeing nothing. Then Merrill Lynch gets hired to look at the books for that May test deal, and it takes them just 10 days to realize something is catastrophically wrong. The failure of the auditors was just total.
The consequences came fast. The Indian government, terrified that Satyam's collapse could hurt the whole IT industry, stepped in immediately. They got rid of the board and set up a rescue. Another IT firm, Tech Mahindra, ended up buying Satyam. And then the legal system kicked in. PwC's Indian partners got fined by the SEC, and eventually, in 2015, Raju himself was sentenced to 7 years in prison.
But the story doesn't just end with a prison sentence. It actually ends with a rescue, a really important lesson, and a question that kind of lingers. Because the government stepped in and Tech Mahindra took over, the core of the company actually survived. 40,000 real people with real jobs got to keep them. And the whole scandal served as a massive wake-up call for India, leading to much stricter laws on corporate governance and auditing to try and make sure this never, ever happened again. So in the end, the lie was exposed, the company was saved, and the man responsible went to jail. But the story of Satyam leaves you with this kind of haunting question. This fraud grew from a tiny, insignificant lie into a monster, right under the noses of some of the best auditors and regulators in the world. It really makes you wonder, how many other tigers are being ridden right now, with their riders just one bad day away from being devoured?